Governor Lowe, thank you for your important talk, highlighting the need for unemployment to be reduced. Two things struck me in your talk. Firstly, when you were showing the chart of part-time jobs lifting from 10% to 30% over the past 50 years, I think it was, you argued that it was wrong to think part-time jobs are bad and full-time jobs are good. It's always struck me that it'd be a good mix to have a part-time job where you got paid full-time. So that should be an objective for all of us here. It's just hard to organise. The second thing that struck me was how explicitly you suggested the Reserve Bank's going to cut interest rates further. I understand the board is meeting in Darwin for the first time in a fortnight. Would it be fair to... I've got two questions. One is, would it be fair to say that the board has a red-hot bias to cut rates before it flies south again? And secondly, where does all this rate cutting end? Is there an effective lower bound in Australia? You know, is it 1%? Is it 0.5%? Is it zero? Is it negative as in some other countries? I think a few years ago you hinted the idea that it might be one-ish, but I wonder if you could also update us on your thinking about if there was a sort of a very pessimistic sort of run for the economy over sometime down the track. How low could interest rates go in Australia before you turn to the more unconventional measures for policy? Thank you.
You asked whether it was fair to characterise the board as having kind of a red-hot bias to cut rates. I wouldn't put it that way. But as I said, we need to be on a better path than we're on. And we've made a start to getting us on a better path. A cut of 0.25% in interest rates is helping. But realistically, it by itself is not going to be enough. So, as I said in my remarks, it's reasonable to expect a further cut in interest rates at some point. Whether it'll be in Darwin or at some other point, we'll have to wait and see. What's the effective lower bound? It's hard to tell, but if you look at the Bank of England, the Bank of Canada and the Federal Reserve, they got to interest rates of 0.5% or 0.25%. And they did unconventional things around that level and a bit before that. So we've seen in Europe, though, the Swiss National Bank have an interest rate of -0.75%, and the ECB is at -40 basis points, and the Swedish Central Bank is at that level as well. So it's technically possible, and I'm very hopeful that we will not need to go certainly to negative territory and all of these the very other low interest rates that the Federal Reserve and the Bank of Canada got to. And if I can, one reason that I say that is because I think the central scenario for the Australian economy still remains quite reasonable. We'll update our forecast in the next month or so, but the central scenario is reasonable. We're expecting household income growth to pick up, not just because of our interest rate cuts, but because of the government handing back some of its tax revenue. There's a lot of infrastructure investment taking place. The terms of trade are rising again. Resource sector investment is going to be positive next year after being negative for 5 years in a row. And the housing market adjustment hopefully is coming to an end as well. So I think the central scenario for the Australian economy is quite reasonable. If it turns out to be weaker than expected, we still have capacity to lower interest rates by amount, and as I said in my prepared remarks, the response is not just a monetary one. Fiscal policy and structural policies have a role to play. So I'm hopeful, and I think it's realistic to expect us to be able to keep away from these very low rates and unconventional measures.
Governor, you talked about, just while we're waiting for the microphone, you talked a lot in your statement about where unemployment is, and for those of us who are economists nerds, the non-accelerating rate of unemployment is what we used to all talk about in our textbooks. I don't think anyone thought it would be as low as it is. And to see interest rates as low as they are, and we're still struggling for wage inflation, what do you think? It looks to me like it's something more structural has gone on. To see interest rates where they are, wages growth where it is. I accept your point that we still have spare capacity, but it feels like something else has gone on. Have you got any thoughts about that?
Yeah, I think that's the perspective I share as well. There's one reason wage growth is weak is because there's still spare capacity in the economy, and I think that's probably at least half the explanation. But the other half is structural. And the structural thing that I see is increased perceptions of competition. Everyone feels like there's more competition out there. And one of the first things I learned in high school economics is when there's more competition, prices are lower. Why do we all feel like there's more competition? I think it's globalisation and technology. What does globalisation do? It widens the market, increases the range of competitors. So we all know, all workers know, there's someone else in the world who can do their job maybe at a lower rate of pay, and we all feel that. And it's affecting our bargaining position. Firms know that as well, that there are other firms somewhere else in the world that could do their business. So firms are very reluctant to put up their prices, so they want to keep their costs under control, so they don't want to give wage increases, and workers are nervous and they feel like there's more competition. So this structural sense that competition has increased because of globalisation and technology. I think it's affecting both the price and wage dynamics in Australia and actually right around the world, and it's the primary reason that inflation's low everywhere, this perception of competition. And I don't think it's going to go away anytime soon. It's something we're going to have to get used to.
Okay, we'll try again. Governor, your rate cut this month doesn't seem to have had an immediate impact on consumer confidence. It was stable or fell a little bit. And there's been talk since then that if you were to go back-to-back with rate cuts, with consecutive monthly ones, that might actually end up spooking households about the state of the economy, which obviously you're not as concerned as that might imply. I mean, worries about spooking them with consecutive rate cuts, is that something that you'd factor into your thinking when you're deliberating on policy? And a quick second one, on the record participation in the labour market, is part of that perhaps households just not being able to make ends meet and more people are having to enter the labour market just to be able to meet their commitments? Thanks.
The effect of interest rates on cuts on consumer confidence is something we think about quite a lot, not necessarily in the context of whether consecutive rate cuts make sense or not. The message that we've had in the past few weeks is that we're not cutting rates because the economy is getting worse. We've cut rates and we'll probably cut them again because we want the economy to be better, not that it's getting worse. We can deal with a lower rate of unemployment. We should aspire to a lower rate of unemployment and stronger employment growth and lower interest rates. And I hope some measures out of Canberra will eventually help that. So I'm hoping that message gets through to the community. We're not cutting because things are getting worse. We're cutting because we want things to be better. And your point about question about participation, it's probably the case that participation is partly rising because of people's low income growth. Households are feeling that their wages are not rising at the rate they used to, and people are staying in the labour force longer, or maybe your spouse starts working part-time because the household income isn't growing at the rate that people wanted to. So I think that's part of the story, but the more fundamental story is that our labour market has generated part-time jobs and flexibility, because that's what people want. 3/4 of the people who work part-time do so because they want to and they're happy with the hours they want. Now, there's a perception that all part-time workers are unhappy, but when the ABS asks, are you happy with the hours that you work, 3/4 of part-time workers say, yes, I'm happy. And I'm doing this because I'm studying, I've got to care for my elderly parents or my children, or I want to play golf. So these are the reasons that people are kind of saying that they want to work part-time. So the ability to do that is kind of fantastic. It's drawn more people into the labour force. And certainly, as I said in my prepared remarks, that there are a group of people who want more hours, and we need to address that. But we shouldn't think of all part-time work as being unsatisfactory. In fact, the bulk of it is what people want to do.
Anyone who's had a conversation with an Uber driver has probably heard that as well. It's the continual refrain from all of them that I speak with. Question over here, thank you.
Thank you. My name's Paul Madden from the Wyatt Trust, which is a philanthropic trust. I guess looking at the graph that reflected the difficulty in movement in long-term unemployment, it set us thinking about with the initiatives for interest rate cuts and infrastructure spending to stimulate the economy further. What's your view in relation to income support payments and the role that they've got in putting money quickly back into the economy, in reducing poverty, in kind of stimulating growth and spending in regional areas where there are traditionally high levels of unemployment?
I take it you're really asking mainly about the New Start allowance. and the case for that to be increased. I don't really want to comment on the specifics of that, but the household income growth is weak, and we need it to be stronger. It used to be that household income growth was 5.5% or 6% a year. In recent years, it's been 2.5% or 3%. So it's very low, and that's one reason people aren't spending, and the economy's softened, because people, unfortunately, having to get used to slower income growth than they experienced in the past. So anything at the moment that can boost income growth, I think, is good for the economy.
Yeah.
So the interest rate cuts will boost household disposable income because people pay a lot of interest, and I hope the tax rebates get through the parliament, and that will boost income, and perhaps in time stronger support payments for unemployed people will help as well, but that's up to the government.
I was struck by the growth in long-term unemployment as well, and anyone who's had a look at, who understands how difficult it is to get back into employment when you've been out of the workforce for more than 6 months, much less 12 months. But that requires more. That requires structural policies to address that. But it does raise the question about New Start in my mind as well. And the Access Deloitte economics work shows pretty clearly what the multiplier effects are. So if we're looking for a boost in economic growth, you'd like to think it's something that's on the agenda. Now I've got two people waving. Clint was here. Thank you.
Governor, Simon Evans. I'm with the Financial Review. It sounds as though another rate cut very soon is an absolute, an almost certainty. When you do that, if the big banks only pass through partial what you're giving, does that mean that you are more likely to then go to unconventional measures like quantitative easing?
The first point is, in my business, nothing's a certainty. I deal
Have you
with
noticed
probabilities and scenarios.
They're finding different ways of asking whether the board's red hot to cut again.
I've been pretty clear that you could expect there's a high probability that interest rates will be cut again, whether that occurs in our historic meeting in Darwin or at a meeting back in Martin Place, I don't know. The point about incomplete pass-through of our cash rate decisions in the mortgage rate, does that increase the probability of unconventional monetary policy? The answer to that is no. Because we're really talking, if there's incomplete pass-through, we're talking about maybe 5 or 10 basis points that isn't passed through. Not that I'm endorsing that to occur, but so that is not by itself wouldn't be enough to trip us over into unconventional policies. And as I said in response to the first question, I think it remains quite unlikely we're going to have to go down that route. The central scenario for the economy is quite good. We can reduce our cash rate further, and there are other policy options coming from Canberra and the states as well. So I think it's quite unlikely, and if mortgage rates don't move down 5 basis points because of incomplete pass-through, that isn't enough to trip us over into unconventional things.
Question over here.
Luigi Falivani, KPMG. To follow Keynesian theory of marginal utility, do you believe that every cut that you take has less impact on the economy?
Not every cut becomes less effective than the one before, but I do think cuts in interest rates are less effective than they would have been in years past. And one reason I say that is that in years past, when we cut interest rates, many people would race off to the bank and seek to borrow more, either to spend on consumption or to buy another property or buy a car. Today, people are much less inclined to do that. We've all, as a society, got kind of a lot of debt. Many of us feel like we've got too much debt. So when interest rates come down, the first thing we think of isn't to run off to the bank and go and borrow more. It's to try and pay down our debt more quickly. So that means that cuts in interest rates don't have the same effect that they used to. It doesn't mean they become ineffective, because we still have an effect on the exchange rate, and we've seen that in the past few weeks. Lower interest rates do increase the free cash flow of the household sector, and some of that will be spent, and lower interest rates also tend to push up asset prices. I think we're seeing some of that globally in the last week as well, not just because of what we've done, but what other central banks are saying. And higher asset prices tend to stimulate more spending. So I'm confident that lower interest rates still stimulate the economy, create jobs and push inflation up, but realistically they don't have quite the same effect that they used to.
Question here, thank you.
Yes, Governor Lowe. Jackie McGill, Chair of TAFE South Australia. My question relates to your comments that the increased globalisation of employees, potentially, and markets is indicating that the current activities that you monitor are less effective so if they're changing, you're seeing a trend. So do the things you monitor within the Reserve Bank need to reflect that increased globalisation? And if so, what would they be?
Well, we monitor the global economy incredibly carefully, as you would imagine, and we try and understand the forces that are operating globally to give low wage growth and low inflation. Because it's not just an issue in Australia. Almost every central bank has inflation below its target. There are a few that aren't, but most are below their target, despite unemployment rates being incredibly low. In the United States, the unemployment rate is the lowest in 50 years. In the UK, it's the lowest in 40 years. In Germany, 30 years. In Japan, 30 or 40 years. So, right across the Western world, unemployment rates are the lowest they've been in decades, in maybe half a century. But that's not generating the wage and inflation outcomes. So I said in a speech the other day, when I first started studying economics, I used to write essays about stagflation in high school in the late 1970s. That was high unemployment and high inflation. Now we've got low unemployment and low inflation. It's a much better combination, but we're trying to understand why it is, and I think primarily it's because of these forces of competition coming from globalisation and from technology. Because technology increases uncertainty as well. I speak to a lot of people in the business community, so they just don't understand what the future technology platforms are going to be. You're nervous about the future, and because of that, you're very careful about your cost base and wage growth.
It's a conversation we were having over lunch, actually, just about the real weight of uncertainty, and even on some of the edges around the pass-through of lower interest rates. But the point about every country in the world, most of the developed countries are actually really grappling with the same thing. The Governor and I were talking about a piece of research that the Reserve Bank did last year, which is really trying to understand it, which does draw these links together around technology, and actually trying to look at it on a firm basis rather than economy-wide basis, and the impact of technology and what companies that are investing heavily in technology and who are very competitive are doing in terms of wage growth, profit share, prices in their business versus other companies that are not investing enough to keep themselves competitive. So there's a lot going on at the moment, and it's difficult to understand the totality of this big structural shift, except to say on the balance of risks, the bank clearly now thinks we can push harder.
Yeah, I think that it means the fact that the underlying inflation pressures are less than they used to be means that we can kind of do a bit better on unemployment.
We're on the side of...
Yeah, we can, because the upside risks on inflation at the moment seem very low to me. That gives us the opportunity to push to a level of unemployment which, when I started studying economics, was considered kind of dreamland, really. But I think we can get a significant reduction in unemployment in Australia without having inflation problems. And we're prepared to play a role in that, but we can't do it by ourselves.
Another question here, thanks.
Andrew Reid from Hender Consulting. I've got the executive labour market in my face every day here in South Australia. As you put up the graphs today, we were feeling that about a year, 18 months ago. So I'm just wondering whether the Reserve Bank's considering how to better get the indicators from the coalface rather than waiting for the proof in the lagging indicator graphs.
We have a very elaborate program to try and get a good read from the coalface, as you say. On your table there, I see our representative here in Adelaide, and he and his team go and talk to people all the time. So if they're not talking to you, I'd encourage you to swap business cards, and I'm sure he'd be very keen to talk to you. We talk across the country, at least 100 businesses every month, and that's a really important input into the discussions at the board. At the board, we talk a lot about the ABS data, but we also talk a lot about what we're hearing from the coalface, so please swap business cards with Matt.
But the other thing, Governor, too, is that I used to work in funds management a few years ago, and there was a conventional wisdom in the markets that the bank looked a lot at the rate of change of the unemployment rate. And so the Governor's spoken a lot today about the reflections on the labour market. And some of the data from the labour market are coming through in a very timely manner now. So if you look at job ads that are posted online and trends in job ads for places like Seek, which is now a collector of a huge amount of data, that information is becoming available really quickly, and you can see movement in that very, very quickly. So I think it's an added thing that I think allows people to get a sense of where the economy is going faster than you would have been able to.
Yeah, so it's a combination, we rely on a combination of the ABS data, which is very extensive, talking to people at the coalface and using the various forms of data that are available from other sources, which we do extensively.
Yeah. A question? Sorry.
Hello, Andrew Marshall. I'm on the TAFE board, but also in the building construction industry. Do you think industrial relations is a big factor that's limiting our labour growth, and what's your view on that? And is there serious reform that's needed, particularly in public sector? I'm in construction building. Some of the EBAs that we see, they're fairly inflexible. Do you think there needs to be a little bit of wholesale reform politically in IR?
Yeah, I'm not sure about that big. By and large, the Australian labour market's done remarkably well. And I think we went through the biggest resources boom in over a century, a little while back, and the economy didn't overheat. We didn't have kind of massive wage explosion. So the economy dealt with that, and the labour market dealt with that in a fairly stabilising way. Workers were able to move around, and wage increases didn't become excessive. So from that perspective, the labour market's delivered reasonable outcomes, and the unemployment rate being 5% is lower than it's been in a few decades. So from the macro perspective where I sit, the labour market and the industrial relations system has delivered reasonable outcomes. That doesn't mean at the level of individual business we can't have more flexibility, but my perspective really is the macro level, and it's done a pretty good job.
I wonder whether, Governor, one of the issues that we might be needing to reflect on is actually the chart about mobility. And I can join the dots a little bit in terms of some work that we did last year where we asked people about the importance of on-the-job training and reskilling. And the results of our survey showed that older people were just less worried about this. And if you do think about job dislocation and the need to sort of have mobility, I think that the points that you're making about training, not just from an employee's perspective, but also employer's perspective, but also from the employee perspective and how we get that right, but also what the right level of mobility is in terms of productivity and all the rest of it.
Yes, because if you read the newspapers or listen to the radio, you think people have all this job insecurity and young people can't stay at jobs very long, and I've got some teenage children, and I tell them they'll have 7 jobs or 15 jobs over their lifespan. They've got to be prepared to move around. But despite all that, the reality is people are staying in jobs longer. I don't understand why that is. Despite all the uncertainty around and all the technology change and structural change in the economy, we're staying in our jobs longer. I think it's kind of linked to this perceptions of uncertainty and competition. You stay with what you've got in an uncertain world, and that people will do that. And firms aren't aggressively competing from workers from other firms because they don't want to pay the higher wages that you'd have to do to attract someone. So we're all just kind of staying around a bit longer, and that has some positives because you can build up more firm-specific capital, human capital, but it probably does make the society less dynamic.
Now, a question here.
Governor, thank you very much today. Russell Emerson from People's Choice Credit Union. During the GFC, I'm not equating now to the GFC, the Reserve Bank cut rates by 1% a couple of times to send a very clear signal. Now, given that the cash rate is effectively sending a signal to consumers and business, is the board open, or does it think there's capacity for changes greater than 0.25, or is it we sort of constrained because there's not really that far to go to zero?
I wouldn't say we're constrained. We basically do what we think is the right thing.
I wasn't shutting down.
In the GFC, there was a kind of a very clear shock. It was very obvious that the setting of monetary policy need to be recalibrated and recalibrated quickly. And so we took the decision to do that. The current environment's quite different. There has not been a kind of a major adverse shock to the global economy. In fact, I was at the G20 meetings last week in Japan, and the IMF was telling us, well, the global economy could look a bit better next year than it has this year. So there's not a kind of a bad shock that we've got to respond to. As I said before, what we're hoping to do is put us on a better path, and we don't need a massive change in interest rates to do that. I think a moderate change supported by some measures from Canberra.
We were talking about where rates were around the GFC. We were sort of talking about the trajectory of rates, and just to remind everyone, so the September 2008, which was when the first cut sort of started rolling in, the interest rate was the cash rate was 7.25, and then very quickly was 3% a year later. But it is the governor and I were talking about how it really wasn't that long ago that we were talking about rates that were 7%. And here we are at 1.25. It's quite dramatic, isn't it?
Yeah, so it's obvious we can't do multiple cuts of 1% like we did in the GFC. And neither should we be thinking about that either. But, we don't move by 25 basis points because we've blinkered into kind of only moving by 25 basis points. So we do what we think is the right thing in the circumstances.
Question here, thank you.
My name's Bill Runge. I'm here representing myself.
Thanks for coming, Phil.
It's a pleasure. It's a great lunch. Cutting interest rates, as you've done, doesn't help savers nor retirees. When you released your last set of minutes, the press poured over them, and I saw a number of reports which said you were concerned about the effect of this, of falling interest rates and the income that retirees were receiving. How serious are you about being concerned about falling interest rates and its effect on retirees and savers? And will you, at your next meeting, put in a good word for savers and retirees?
Well, at the last meeting, I put in a good word for the savers, and I'm reminded of every single day when I turn up in my office, there are a pile of letters from savers telling me the difficult circumstances that our decisions have led them to be in. So I'm certainly very conscious of it, and we had a long discussion of it at our last board meeting, and that was reflected in the minutes and the speech that I gave on the day we cut interest rates. So we take it seriously. But it turns out that for every dollar the household sector earn in interest income, they pay $2 in interest. So the household sector is a very substantial net payer of interest to banks. So when we cut interest rates, the household sector in net terms has to pay less interest and has more money in its pocket, and spends some of that money, and that helps employment and inflation. So we have to look at the kind of perspective from the economy as a whole. And our judgment remains that lower interest rates will stimulate the economy through improving the cash flow of the household sector and the exchange rate and the other things I talked about before. So it's difficult for the savers, I understand that, but it's the right thing for the overall economy. And if the overall economy is doing better, then in the end we'll all do better. In the meantime, it's very difficult for the savers.
Question here, thank you.
Mike Rangi from the Global Centre for Modern Ageing, and also cousin to the last question that was asked. Governor, thanks for your presentation. 30% of people in their 70s in Sweden are working, and 10% of people in Sweden in their 80s are working. And most of these people are working because they like the work rather than necessary primarily for the income. I see here you're reporting 20% of males over 65 working, 15% females, so we're quite a way behind Sweden, with an inevitable set of incentives for older people to start working more. Does it make any sense to exclude older people from our participation thinking and into the future? And what's the impact on the things you've presented today on a much larger group of older people working in the future?
Well, it doesn't make any sense to exclude them from our thinking, and we don't do that. And as showed in one of the graphs, we track the participation rate of older Australians carefully, and it's making a significant contribution to overall participation in the country. And I think it's coming around from a couple of things. One is better health outcomes, and the jobs that people are doing, they don't wear out the body like they used to, so people have the potential to work long because their bodies aren't wearing out and the health system's better. So that's positive for the individuals and positive for the society. The changes in the pension arrangements are obviously playing some role as well. And the fact that people's incomes haven't been rising as quickly has probably kept some people in employment longer than they might have wished. So there are kind of a range of factors. We track them quite carefully, and it's having a significant effect on overall labour supply in the country, which is a good thing. So we don't ignore it. No.
Yeah, I think one of the things I would say, if you look at some of the charts that the Governor put up, and in particular the decline in the labour force participation rate of men aged 25 to 54, and have a look at some of that relative to some changes in certain industries and sectors, that one of the real challenges is to make sure that we pull people back into employment if they've been dislocated through work. That's why it's so important to get the long-term unemployed back in, because it becomes increasingly difficult. And so if you want people to maintain their labour force participation all the way through life, one of the really important things is to make sure that they don't become disconnected from that at a particular point in time, either because they exit because of a job loss, if it's a female participant, they exit because of child rearing or whatever else, that we have those transitions back. And it underscores the point the Governor was making about the ongoing training, the importance of ongoing training to enable that. But to enable the sort of the sustained labour force participation as the economy shifts through technology and the like, it's very, very important. In the past, there's been a real challenge getting older workers back into the workforce, but I think business is getting much better at it now. Question here.
Yes, Jane Durham from Funds SA. I was just interested in the Reserve Bank's thoughts on cryptocurrencies, and in particular the Facebook announcement that's very recent.
Well, I think there's a lot of water to flow under the bridge before Facebook's proposal becomes kind of something that we're using all the time. There are a lot of regulatory issues that need to be addressed, and they've got to make sure that there's a solid business case. So I think we've got to be kind of careful not to jump to conclusions. I have long thought that a kind of a cryptocurrency would not really take off in Australia, because we already have a very, very efficient electronic payment system that allows any one of us to make bank payments to another person in 5 seconds just knowing their mobile phone number. So there's an opportunity for me to advertise the new payments platform, which I hope you all know about, and I hope you all have your pay IDs, and if your bank's not offering it to you, go find one who does. So under that system, we can move money between bank accounts anywhere in any two bank accounts in the country within 5 seconds. So it's incredibly flexible. So we at the central bank, we have thought about the case for issuing tokens instead of banknotes. So we could issue kind of electronic versions of Australian dollars, which sit in an app on your phone. Technologically, it's possible, and we could do that rather than issuing pieces of polymer. But we've made the decision, at least to date, that wasn't in the public interest to do that, because people can already move money around electronically between their bank accounts at no cost, very flexibly. So there wasn't really a strong public policy case for us to issue kind of an electronic token. Didn't see the public case for that, and whether Facebook can do that in a way, we'll have to wait and see.
So I was talking to someone who said they'd written a paper about 25 years ago about how paper money was going to go by the by. But we still have more notes on issue now than we used to. Is that correct?
Well, the stock of currency outstanding relative to the size of the economy is the highest in 50 years.
There you go.
There are 14 $100 notes out there for every person in the country, and 28 50s. I don't have my share. I don't know who in this room has theirs.
Can't remember the last time I saw
and
$100
despite the
note.
kind of the cash is not being really used for electronic payment payments, but people still hold banknotes for reasons that you can speculate on. But I while ever we've got a kind of a first-class domestic payment system that's cheap for people to use and offers great functionality, which our new system does, I see a fairly low probability of that being displaced by some alternative payment system. But if our system doesn't offer the functionality that people want, not charge us too much, it will be replaced. But our system, the Australian system, doesn't. We have a really world-class payment system here now.
I'm sitting here glaring into lights.
Yes,
I think I'm going to the back of the room here.
Hi, Governor. My name's Megan Dillon with ABC News. Given that the federal government seems very committed to delivering a budget surplus this financial year, what options other than rate cuts does the Reserve Bank have to boost the economy?
And does the Reserve Bank have? Well, our main instrument is interest rates, so we don't really have any other options. But public policy has other options. I've long been a very strong advocate for investment in infrastructure. I think now's the right time to do it. We've got the capacity in the economy, the labour force that can do that. I mean, it adds to the supply capacity of the economy, so it increases the productive capacity of the economy over time. And there are a range of ways that this can be financed. Right today, the Australian government can borrow at the cheapest rate that it can since we became a federation. I think the 10-year government bond rate's 1.35%, and the government can borrow for almost 30 years at less than 2%. So there must be some projects out there with risk-adjusted rates of return 1.5 to 2%. So there's capability to do more investment in infrastructure, provided we choose the right projects and the construction risk is managed well. There's scope to do that while keeping budgets in surplus. The other thing that can be done, which I mentioned at the end of my prepared remarks, is various structural reforms, then the end shouldn't cost that much, that give businesses a greater incentive to invest, hire, expand, employ people. So having a mindset, not just the federal government, but all governments, of creating an environment that encourages businesses, like in this room, to invest, hire, expand, innovate and employ people. So if that's our mindset, there's no shortage of things that can be done while preserving the budget surplus. And I think we need, as a country, to have a laser-like focus on things that encourage businesses to expand, employ, invest and innovate. And that's not my responsibility. All I do is my board set the overnight interest rate. That's all we can do.
I think that's the Governor hand passing it to everyone in the room.
It's business, businesses here can employ people, expand, innovate and hire people.
The New South Wales Treasurer has obviously been paying attention to you, Governor, because yesterday in his speech at CEDA, he actually made exactly that point and said that they are borrowing at 1.8%. And they actually have created a generations fund where they're putting money into that fund to be a debt reduction fund in the future, where they're targeting CPI plus 4%. So they're leveraging exactly the differential that you're speaking to.
Yeah, but I mean, sorry, can I just make one other comment? One reason that we have low interest rates in Australia around the world is a lot of people want to save and not many people want to invest. So when lots of people want to save and not many people want to use the savings to invest, what happens? I'm sorry, the savers get low returns. And it's not the central banks really, it's the high desire to save around the world relative to invest. If you are an entity that wants to invest, it's fantastic because you can get low funding. So in Australia, interest rates right across the spectrum are the lowest since Federation this morning. In the last 118 years, you could not borrow cheaper than you can today. So if you want to invest, I hope you've got good ideas. There's plenty of funding there.
On that note, I'm unfortunately going to have to close the Q&A, which has been quite good fun for me, and invite Henry Mentz, the Managing Partner of South Australia from Deloitte, to deliver the vote of thanks.